program is brought to you by LGT Wealth Management. Welcome to the next chapter in Trusted Advice, where global strength and deep local relationships shape wealth that lasts for generations. LGT Wealth Management, lgtwm.com.au.
Hello, welcome to the Global View on this Tuesday. I'm Andrew Gagan. Thanks for joining us again here at AusBiz. Let's get across what we saw overnight. Markets beginning the week cautiously. That's ahead of the Federal Reserve decision on interest rates. Wall Street's main indices slipping, with all but one S&P 500 sector in the red, while Treasury yields gained. And just in terms of those stocks that are moving, well, Paramount Skydance has launched a hostile $108 billion bid to buy Warner Brothers Discovery in a last-ditch effort to outbid Netflix and create a media powerhouse that would challenge the dominance of the streaming giant. Netflix appearing to have emerged victorious on Friday from a weeks-long bidding war with Paramount and Comcast. Elsewhere, Nvidia shares rose as President Trump said that he will allow it to ship its H200 chips to approved customers in China and other countries under conditions that allow for continued strong national security. Chipmaker Marvell fell heavily after used car dealer Carvana beat it to securing a spot in the S&P 500. Carvana shares surging as a result. Confluent shares skyrocket after IBM said it will acquire the data infrastructure company for about $11 billion. And Tesla proved to be a drag on the S&P following Morgan Stanley's bearish view on the EV maker, while shares of lithium miner Albemarle rose on a broker upgrade on expectations that lower interest rates could unlock delayed EV and storage demand, seeing lithium demand surprising to the upside. Meanwhile, Oppenheimer Asset Management has set a year-end target for 2026 of 8,100 for the S&P 500. That's the most bullish forecast among Wall Street brokers, citing expectations of strong corporate earnings and continued resilience in the US economy. It implies an 18% upside for the last close and compares with Deutsche Bank's 8,000 forecast for the index. Well, US Treasury yields rose, the US dollar gaining against the Japanese yen following a strong earthquake in Japan. The magnitude 7.6 quake hit Japan's northeast region, prompting orders for 90,000 residents to evacuate and tsunami warnings that hours later were downgraded to advisories. In Europe, ECB Executive Board member Isabel Schnabel said she was optimistic about the economy and expected the next policy rate move to be higher, saying, compared with our September projections, the risks are clearly tilted to the upside. US Treasury yields climbed to the highest in more than 2 months overnight as investors prepare for the Fed's policy announcement. The 10-year rising to 4.17, the 2-year was up to around 3.6. The Australian 3-year government bond yields rose to 4.09%, while the 10-year was up to 4.74, with markets pricing in no chance that the RBA cash rate will be cut at today's board meeting and a 90% chance of a hike by June next year. US dollar index up slightly on the day. The Aussie is trading at 66.2 US cents, and oil prices have slipped after Iraq restored production at one of its oil fields while investors contemplated ongoing talks to end the war in Ukraine. Brent crude futures down 2% at $62 a barrel. Copper little changed. Iron ore down 1% to 106 US a tonne, and gold edged lower ahead of the Fed decision. Spot gold at around $4,190 an ounce, while Bitcoin is trading just below 91,000 US. All right, let's get across what we are seeing on Wall Street. Steve Sosnick is joining us from Interactive Brokers. Steve, welcome back. All right, so clearly the big event this week is the Fed meeting. How are you seeing markets react to that? In particular, I see you sort of looking at that correlation between Treasury yields and stocks. What are you seeing?
Well, good morning, Andrew. It's a pleasure as always. I think, clearly we're focused on Wednesday's meeting. There's no question about that. We are starting to see yields tick a little bit higher. It started last week and it's been continuing. Now, it's been more the absolute level of the yield curve, not so much the steepness, although we have steepened slightly. We're at just under 60 basis points between 2s and 10s. When I last looked, the range has pretty much been in that 50 to 60 range for several months now. And I think that by we're sort of flirting with a steeper yield curve, but we're not there yet. It will depend a bit on what the on number one, what Powell has to say, and number two, what whoever his successor will have to say when he starts testifying in front of Congress. Because I do think I'm hearing people expressing fears about inflation expectations.
Now, Steve, I see you're off the leash. You can actually give year-end price targets. That's that's great. Let's because I just mentioned obviously for next year, Oppenheimer there, pretty bullish, isn't it? 8,100 for the S&P by the end of next year. What are you seeing for year-end price targets this year, at least?
Oh, for this year, I would say, we're talking. I think we're going to make a run in the S&P. It seems inevitable for a new high, whether that's 6,900. My guess is maybe they shoot for a round number of 7,000, just because, things get don't short adult tape. It gets easy to push around a market when there's very light volume. I think that's less relevant than the year ahead. There's two things I'm really looking forward to year end. Well, I guess three. Number one is, do we get the Santa Claus rally, or does Chairman Powell play Grinch on Wednesday? But assuming we do get that, is there any real volume participation going in on that one? And do we get a high in the NDX, the NASDAQ 100, if we get a high in the S&P 500? One of the problems we had going into 2022, which was pretty much the last time we saw a bear market, was that the NASDAQ peaked on November 19th and the S&P 500 peaked on January 3rd of that year. So we opened the year at a high and then never looked back and didn't get there for almost 2 years, basically. But that was one of the tells, as we started to broaden out a bit, which is generally a good thing. But considering how wedded we were then, and even more wedded now to tech performance, I think we do need to see some participation from the techs. The late news about semiconductors might push it in that positive direction, although 25%, the U.S. government getting a 25% cut from Nvidia, any chips they sell to China, sounds as much like a shakedown as it does a deal. But there's definitely those are the things that I'm watching into year end.
Now, also interesting to see what's playing out in terms of that play for Warner Brothers Discovery. Steve, what do you make of that with Paramount Skydance coming over the top of Netflix?
Yeah, I mean, I don't think it was a big surprise. I think Paramount was very upset by the fact that they seem to be beaten out by Netflix. As with so many things now, it's just, it's who knows whom. And, the Ellison family is very tied up with the president, and Jared Kushner is the president's son-in-law, said to be part of the Paramount deal. On the other hand, there was supposedly some rumors that Ted Sarandos, the head of Netflix, had gotten quite friendly with the president. This is, to me, that's sort of uncharted waters. There are probably very legitimate reasons for a deal of this nature to be scrutinized, but I think we're as much into the who do you know and how can you influence the outcome phase, rather than just strictly dollars and cents. With any takeover deal, it's always important to consider whether there will be regulatory challenges, whether there will be difficulty getting approval. But in this case, you have, I'm going to argue, a whole other level of consideration because of the personalities involved potentially.
And some very alpha personalities, you would have thought, at play there. Steve, interested also, I mean, obviously you gave us your outlook there for stocks. What are you seeing with some of those alternative assets, particularly what we've seen with gold this year? Where do you see that going potentially into Christmas and beyond?
Gold, I think, is in a very sweet spot here because, remember the gold price being denominated in U.S. dollars. I don't think the U.S. dollar is going to race ahead anytime soon. I think you still have inflation fears out there, which are not going away, which plays into gold strength. Again, I always caution. Sometimes gold is an inflation hedge, sometimes it's the anti-dollar, but I think both of those factors are in play right now. I think also the fact that Gold has been a wonderful performer, in spite of Bitcoin not really living up to its name of digital gold right now. I think that plays into the whole decision process. So, I remain constructive on it. I don't know that I look for another sort of parabolic move upward, but right now I think the supply demand and the psychological considerations are playing into gold's favor.
Meanwhile, digital gold, Bitcoin, I know you keep an eye on it, Steve, but do you feel as though that is reflecting market sentiment more broadly at the moment or not?
I do, and that's kind of for better or worse at some point. I mean, what happened was you had this rush this year where I termed it as Bitcoin is now for normies. Basically that normal people could now get involved in Bitcoin. That's been a while since the ETFs came into prominence, but they became very popular when you had the election of a president who was obviously leaning into cryptocurrencies, and so a lot of people bought in. You had tremendous inflows into the Bitcoin ETFs, but now what we're seeing is that money going in the opposite direction. I believe it was the fifth week in a row where there were net redemptions in the IBIT ETF, BlackRock's, which was parenthetically the single best ETF launch ever. So it shows you how much that became a mainstream investment idea. Problem is, when the herd moves in one direction, it pushes prices up. When it moves in the opposite direction, it pushes prices down. Also, I think the events of October 10th, while they looked sort of like a flash crash in cryptocurrencies to those of us who are not necessarily full-time crypto people, it really severely impeded the liquidity in that sector. So whereas Bitcoin has been sort of floundering at lower levels, some of these second-tier coins have really gotten decimated. And the liquidity structure underlying crypto has really been impeded somewhat. So I think, and also then you had a lot of people rushing into the digital asset treasury companies, basically MicroStrategy copycats. And in that situation, we've seen the premiums come out of those stock prices. They were trading at big premiums to net asset value. It seemed like a money machine. Buy crypto, for X and sell stock at 2 times X, and rinse and repeat. And that's gone away too. So I think I don't necessarily feel so dire about crypto, but I think it's pretty much the opposite of what I've said about gold. I think a lot of the trends are not really pointing in a friendly direction, and it's going to take some work before we sort of put in levels that can get the bulls excited again.
Steve, enjoy the rest of your week. Thanks for joining us from Interactive Brokers.
Andrew, take care.
Let's turn to the local market then. We're expecting a lower open when we get going in just a couple of minutes' time. As you can see, SPI futures off by 0.1%. And clearly, the big event today the market will have its eye on is that RBA decision at 2:30 Eastern this afternoon. We'll get right across that with our special panel. And then, of course, we'll hear from Michelle Boyd. Stay with us.
This program is brought to you by LGT Wealth Management. Welcome to the next chapter in trusted advice, where global strength and deep local relationships shape wealth that lasts for generations. LGT Wealth Management, lgtwm.com.au.